Let's discuss Ind AS 2 inventories. First one is objective of Ind AS 2. The objective of Ind AS 2 is to prescribe accounting treatment. Ind AS 2 prescribes accounting treatment for valuation of inventories, focusing on determination of cost and expenses to be recognized and written down. The value of inventory to be written down to net realizable value. If the cost of inventory is more than the net realizable value, then we need to brings down or written down to the value of net inventory to net realizable value. Next one is scope. The scope of Ind AS 2 applies to all inventories except the following. Financial instrument. As per financial instrument, Ind AS 109, this is not applicable. Ind AS items covered in Ind AS 109 is not covered here. Next one is biological asset related to agricultural activities not covered here. Mineral ores is not covered here. Okay. Next is key definitions. Key definitions. Inventories. Inventories. What is the definition of inventory? Asset. Inventory is an asset held for sale in the ordinary course of business. That is, if I am doing a retail business, I am having some inventories that will be valued as per Ind AS 2. In this process of in the process of production of such sale, or is in the process of production of such sale, in the form of material or supplies to be consumed in the production process. Production process use பண்ற மாதிரி இருக்கலாம். Or rendering of services. If I am rendering a services, I can use inventories for my services to be performed to my client. Net realizable value. What do you mean by NRV? That is net realizable value. It is an estimated selling price less cost of completion less cost of sale, expected cost of sale. To compute, example, to compute net realizable value, let's say the company has a product in inventory that can be sold for 10,000 rupees, that can be sold for 10,000 rupees. This is selling price once completed. The estimated cost to complete the product, estimated cost of completion is 1,000 rupees. Cost to sell, the estimated cost of sale is 500 rupees. Estimated selling price minus cost of completion minus cost to sell. We'll get a value of net realizable value. Net realizable value. Cost. Cost include all purchase cost and the cost of conversion and other costs incurred in bringing the inventory to their present location and condition. Okay. Next one is measurement of inventories. Under measurement of inventories, we have cost of purchase, the cost of conversion, and other costs. That is, we have seen the definition of cost. Cost includes cost of purchase, cost of conversion, cost of incidental cost, other incidental or directly attributable cost. Okay, what do you mean by purchase cost? Purchase cost comprises of purchase price of the product or inventory, purchase price of the inventory, import duties paid on purchase, taxes paid on purchase. In case of taxes, it should not be refundable. Okay, tax should be included only if it is not refundable. If in case input tax credit is available, then we should not include the cost. And transportation cost, handling cost, other cost directly attributable to the acquisition of materials. Next is cost of conversion. What do you mean by cost of conversion? The cost incurred for converting the material into the finished goods. That includes cost directly related to production, such as labor cost, systematic allocation of fixed variable overhead, and variable overheads that are incurred in the converting material into finished goods. These costs are incurred to converting material into finished goods. Other costs only included in the cost of inventory to the extent that may incurred to bring the inventory if management intended to the cost incurred for the purpose of bringing the inventory to their present location and condition, then the other cost should be included in the cost of inventory. Measurement of cost, closing stock and measurement. Finished goods and WIP will be valued at lower of cost or NRV. Lower of cost or NRV. Raw material valued based on the following. In case of two categories, one is 1 and 2. If raw material is based on finished goods, okay, if finished goods are expected to be sold at above cost, finished goods are sold at and above cost, then raw material is measured at cost. If finished goods is sold above cost, that is the cost of finished goods is 100 rupees. Okay, sorry, the sale value sale value of finished goods is 100 rupees. Cost of inventory, that is cost of production, is 80 rupees. Then it, closing stock should be closing stock of raw material. Closing stock of raw material should be valued at cost. In case sale value of finished goods is 100, cost of sales or cost of goods sold is 120 rupees. Then closing stock of raw material should be valued at cost or replacement cost, lower of cost or replacement cost. It will be replacement cost will be given in the question. If finished goods is expected to be sold below cost, that is cost is 120, the sale value is 100. So we need to value raw material is measured at a lower of cost or replacement cost. Next, inventory can be measured at item by item basis. Example, a car company. Take an example of Rolls Royce. Amount in crores. These are all in crores. Model. First one is Phantom. In case of Phantom, the closing stock is there are 3 cars. And Ghost, there are 3 cars in Ghost section. Okay, the cost of item stock item 1 is 100. Net realizable value of the car is 8 crore. We have to value item by item basis or group basis. As per Indians 2, entity has an option to follow item by item valuation or group valuation. Group means Phantom has a 3 cars, this is one group. Ghost has 3 cars, this is one group. So it can value item by item basis or group basis. This will compare this value, the cost and the NRV, and can compare this value and this value. Okay, so for valuing the item stock item 1, cost is 10, NRV is 8. In case of item by item basis, the lower value is 8 crore. It should be taken. In case of car number 2, the cost is 9 crore. NRV is 12 crore. The lower value is 9 crore. It should be taken. In case of model 3, the cost is 12 crore and the NRV is also 12 crore. So the value of item should be valued at 12 crore only. Next, group basis. In case of group basis, cost is 31 crore and the NRV, total of NRV is 32 crore. So the lower is cost. So 31 crore should be taken in case of group basis. Next, Ghost model 1. Cost is 15 crore, NRV is 12 crore. 12 crore should be taken. Next, the stock item is stock item 2. Cost is 8 crore, NRV is 12 crore. The lower value is 8 crore cost. The cost should be taken. Lower of this. Third one is 10 crore and 10 crore. Cost also 10 crore, NRV also 10 crore. We should take 10 crore for valuation. Total of this will be shown at 30 crore in inventory. In case of group basis, we need to compare cost and NRV. This is cost is 33 crore and NRV is 34 crore. We need to take 33 crore. The total of this and this, that is 29 crore and 30 crore will be having 59 crore in case of item by item basis. In case of group basis, we have 31 crore and 33 crore. Total 64 crore. The inventory should be shown at 64 crore in case of group valuation. Inventory is measured at every year end. Every year end, that is balance sheet date. In my example, 31st 12 2022, that is December is my reporting date or balance sheet date. So the cost of inventory is 10 crore, the NRV is 12 crore, the cost lower will be 10 crore. Next, the cost is 10 crore, net realizable value is 9 crore, I should value 9 crore. The value between this and this should be written down to profit and loss account. 1 crore should be written down to P&L. Next is cost is 10 crore, net realizable value is 8 crore, then it should be valued at 8 crore. The value between this 1 crore should be written down to profit and loss account. Cost of inventory. In case of purchase of goods, in case of purchase of goods, how will you value the goods? Cost of inventory, cost of purchase. To value the cost of purchase, cost of purchase price, cost of purchase price of the material or goods. The trader can give, I will receive a trade discount. Trade discount should be reduced from cost of purchase. Next is rebate. If any rebate is provided by seller, then I should reduce this. Import duty paid, import duty and GST. Import duty paid, import duty should be included. In case of direct taxes, it should be non-refundable, then it should be included in the cost. Next is transportation cost and freight charges, handling charges, insurance charges, buying commission, any buying commission paid, it should be included. You will get a value of purchase price. In case of purchase of goods is produced, in case of purchase of goods, we have seen what we have to do. Next, in case of goods are produced by the company, then direct material cost also includes this cost. Cost of purchase என்ன calculate பண்ணுமோ same can be applied for direct material also. Add labor cost incurred for producing the goods. Next is production overhead. Production overhead includes fixed overhead or variable overheads. That is variable overhead and fixed overhead. So we will get a value of cost of production. Cost per unit. How will you calculate cost per unit? Cost of purchase or cost of production divided by actual number of units produced or purchased. Actual number of units produced or purchased. Now calculate closing stock. To calculate closing stock, units in closing stock will be given in the question. Next, cost of purchase we have computed here. Same will be multiplied with closing units. If I have a closing units of 100 and I have a cost per unit is 10 rupees, then I have closing stock value is 1000 rupees. Next is cost of goods sold. The total cost of production or purchase minus cost of closing stock, cost of goods sold I need. So total cost of production, that is I have produced 1000 units into 10 rupees minus 1000, I will get a value of 9000. Okay. Next one is cost of sales. Cost of sales means cost of opening stock plus cost of purchase or cost of production minus cost of closing stock. Cost of production we have computed from here, cost of purchase and cost of production. Okay. Next, points to be considered while solving the problem. If question is silent about whether taxes are refundable or non-refundable, assume all taxes are non-refundable. Next, allocation of fixed overhead. How will you allocate fixed overhead? There is an fixed overhead are two types. One is what? Absorbed overhead, unabsorbed overhead. There is a absorbed overhead, unabsorbed overhead. Fixed overhead allocated to cost of production during the period. So that is fixed overhead allocated to cost of production during the period. That is known as absorbed fixed overhead. How will you compute the absorbed fixed overhead? Absorbed fixed overhead. Actual unit produced into multiplied with fixed overhead recovery rate. How will you complete? Complete. Every complete one. So how will you compute fixed overhead recovery rate. Total fixed overhead divided by higher of following. Higher of following. Normal units are actual units produced. Higher of following. Normal units are actual unit produced. So the remaining overhead will be transferred to profit and loss account. Actual unit produced into fixed head overhead recovery rate. How to compute fixed head overhead rate? Total fixed overhead cost divided by higher of normal units or actual units produced. We will get a value of fixed overhead. It will be multiplied with the actual unit produced. We will get a absorbed fixed overhead. So the remaining value, the remaining fixed overhead are expensed to profit and loss account. That is total fixed overhead minus absorbed fixed overhead will give you the unabsorbed fixed overhead. So if total unit produced is not given in the question, in case the total unit produced is not given in the question, actual unit produced எப்படி கண்டுபிடிக்கணும் அப்படின்னு பார்த்தா actual unit produced equal to units of closing stock of finished goods plus units sold in finished goods minus opening stock of finished goods. Finished goods, if closing stock of finished goods is 100, units sold 900 plus units in opening stock 200. So the value actual unit produced it should be reduced. Formula தப்பா போட்டுருக்கேன். Opening stock of units and opening stock of finished goods should be reduced. So will be unit produced will be 800 units produced during this period. So example, total fixed overhead 15,000. Normal production unit. Normal units is 500. Allocate fixed overhead if actual production is 400, actual production is 500. In case of first case, fixed overhead recovery rate we need to find out. In case of first, the higher of the following, higher of this 500. So 15,000 divided by 500 give you 30 per unit. Allocation of total fixed overhead of 15,000 as follows. The cost of production of 400 unit into 30, 12,000 is cost of production. Balancing figure 3,000 will be transferred to profit and loss account. This is absorbed overhead. This is unabsorbed fixed overhead. Next one is the higher value is actual production units, that is 600. So 15,000 divided by 600 units will give you 25,000 per 25 per unit. Allocation of total fixed overhead of 15,000 are as follows. Cost of production 600 into 25 15,000. Total production fixed overheads are allocated to cost of production. The balance is nil. So there is no unabsorbed overhead. All overheads are absorbed for cost of production. Okay. What are the exclusion from cost of purchase and cost of production? What are the exclusion? Cost of purchase and production kulla. These are the following listed out here. It should not be included in the cost of production or cost of purchase. Okay. First one is abnormal amount of waste of material, labor, and other production cost. Any abnormal cost or loss, any abnormal cost or loss should be included, should not be included. Storage cost, unless they are necessary during the production process. In case of it is necessary for during the production process, it should be included. If storage cost is generally, storage cost should not be included in cost of production or cost of purchase. Administrative overhead, administration costs are not included in cost of inventory. Do not attribute, do not contribute to bring the inventory to their present location and condition use ஆகாம இருந்துச்சுன்னா it should not be included. Selling cost, that is selling commission and warranty cost should not be included in the cost of production and cost of purchase. Interest cost or finance cost unless it is allowed by, unless in days 32 or 34 தெரியல என்னன்னு தெரியல. In days borrowing cost in days வந்து allow பண்ணா add பண்ணிக்கலாம். Cash discount or yearly settlement discount. Cash discount or yearly settlement discount. இங்க வந்து என்ன பண்ணணும்? In days 32 borrowing cost. In days 32 தானே? Let me check. In days 32 ல அதே உல்டாவா சொல்லிருக்கேன். Days 23. Okay. Unless in days 23 allows. Cash discount should not be included. Cash discount should not be included. Cost formula. There are two formulas. First in, first out method and the weighted average cost method allowed for determination of cost of inventory. Specific identification method is used for items that are not interchangeable and goods and services are produced or segregated for a specific project. இது வரணும்னா specific identification method யூஸ் பண்றோம். இல்லைன்னா FIFO method or weighted average cost method. Net realizable value. Inventories are measured at lower of cost or NRV. Net realizable value is estimated selling price in the ordinary course of business less estimated cost of completion and estimated cost necessary to make the sale. Write downs. What do you mean by write downs? Inventory should be write down to net realizable value when the cost is not recoverable. When the cost is not recoverable, this is common when the inventories are damaged, absolute, or when the selling price have declined. இதெல்லாம் வந்துச்சுன்னா ரிட்டன் டவுன் பண்ணுங்க. என்ன பண்ணுவோம்னா காஸ்ட் காஸ்ட் cost of inventory is 80. The selling price NRV is 100. NRV is 70 rupees. The difference between this 10 will be written down. Write down to down and transfer to P&L account. Okay. Recognition as expenses. When inventories are sold, the carrying amount is recognized as an expenses in the period in which the related revenue is recognized. Recognition of expenses when the inventories are sold. Inventories sale achna, the revenue should be recognized. Any write downs to net realizable value and any losses of inventory should be recognized as an expenses in the period they occur. Okay, write downs on the and any losses of inventory should be recognized as an expenses in profit and loss account in the period they occur. Illustration. Examples of cash calculation. A company purchases raw material for 10,000 rupees, incurs transportation cost of 1,000 rupees, and conversion cost of 3,000 rupees. The total cost of the inventory would be 14,000. That is 10,000 plus 4. 10,000 plus 1,000 plus 3,000 give you the 14,000. Examples of written down value. If a retailer has a hold stock purchased at 500 per unit due to decline in the market price, the selling price of the stock is 400 and the selling cost are estimated 500 rupees, the net realizable value becomes 350 rupees. Hence, the inventory should be written down to this value. Inventory should be written down to this value. That is 500 minus 350. So 150 will be transferred to P&L account. Okay. Examples of NRV adjustments. A manufacturing company holds a finished goods inventory that costs 2,000 per unit. If the estimated selling price is 2,200, the cost to sell is 300, the NRV would become 1,900, requiring a written down. Cost is 2,000, 2,200 minus 300 will give you 1,900. So the 100 rupees will be written down to profit and loss account. Steps to steps to steps to solve joint product cost allocation. Identify joint product and byproduct. What is joint product? தேடிய தருணங்கள் எல்லாம் Let's start with steps for joint product cost allocation. Joint product cost allocation. Identify joint product and byproduct. What I mean by joint product? Products that are produced simultaneously from a common process and have a significant relative sale value. When goods are produced, there are two main products. Joint product is nothing but main products. Okay, main products are called as joint product. Products are that are produced simultaneously from the common process and have a significant relative sale value. இருக்கிறதுலாம் வந்து joint product. Next, byproduct that have relatively minor sale value, that is compared to joint product. If joint product has a selling value of 1,000 rupees, but the byproduct has a value of 100. Okay, selling value, sale price, sale value. This is known as joint product and byproduct. Determine joint cost. How to find out joint cost? The joint cost are cost incurred up to split off point where product becomes separately identifiable. Where product becomes separately identifiable. Choose allocation method. First one is identify the joint product and byproduct. Next one is determination of joint cost. Next is allocation method. Allocation of joint cost. Based on, we will commonly use the value, sale value at a split off point method in Ind AS 2. Other methods are not relevant for exam purpose. These are all relevant for inter level only. Now we have only sale value at a split off point. Calculate allocation. It is allocated based on sales value. Apply the chosen method to allocate the joint cost among the joint product. Next, account byproduct. Deduct the NRV of byproduct from total joint cost or treat the byproduct income in other income. Okay, wow. Deduct the value from the joint cost and it should be shown at other income in income statement. Record in financial statement. Allocate joint cost to each product and calculate the cost per unit. Recognize the cost of goods sold and inventory value in the financial statement. In case of scenario, joint product with a byproduct and a scrap income, Moss Limited. Moss Limited produces main product. Main product, we have MP1 and MP2 and the byproduct is BP. From the common production process, the following details are provided. Total joint cost is 3,20,000. So, output of MP1 is 5,000 units. Output of MP2 is 4,000 units. Byproduct has 2,000 units. The sales price is 50, 60 and 50 and 20. So, additional cost for byproduct incurred and income from scrap sale is 2,000. The inventory closing stock is 250 and 100 unsold units. Required. Calculate NRV of byproduct. Allocate joint cost to MP1, MP2. Compute cost per unit and value of closing inventory. Cost per unit and value of closing inventory. So first we need to find out NRV of byproduct. NRV of byproduct is NRV of byproduct. First we need to find out what is the sale value. Sale value of NRV equal to 2,000 units into 20 per unit. Sale value will become 40,000. The additional cost, further processing cost is 10,000. 40,000 minus 10,000 equal to 30. That is NRV of byproduct. Next, adjusted joint cost. That is after deduction of NRV of byproduct and scrap value. That is total joint cost is 3,20,000 minus 30,000 minus 2,000 will give you 2,88,000. The sale value at a split up point. What is the sale value of MP1 and MP2? The sale value of MP1 is 3 lakh. The sale value of MP2 is 2 lakh. The total value is 5 lakh rupees. So the joint cost allocation based on sales value is 2,80,000 into 3 lakhs divided by 5 lakh. 2,80,000, 88,000 into 3 lakh divided by 5,000 will give you 1,72,800. Next MP2, 2,88,000 into 2 lakh divided by 5 lakh give you will give you 1,15,200. So cost per unit for MP1 1,72,800 divided by 5,000 equal to 34.56. For MP2 1,15,200 divided by 4,000 will give you 28.80. This is cost of production per unit. Closing stock of closing inventory value. So we have MP1 has 250 unit and MP2 have 100 units multiplied with the cost per unit will give you MP1 closing stock value of MP1 is 8640, closing stock value of MP2 is 2880. That's it. Disclosure. So accounting policies are adopted and cost formula used. Total carrying amount of inventory and classification. Raw material, work in progress, and finished goods. Classification: raw material, work in progress, and finished goods. The amount of inventory carried at NRV. The amount of inventory carried at NRV. Amount of inventories recognized as expenses during the period. Details of any write-downs and the reversals of during the period. That's it. Conclusion: Ind AS 2 ensures that the inventories are valued properly in the financial statement, reflecting the true economic value. Standard provides a framework for cost measurement and subsequent expense recognition, ensuring the transparency and consistency in accounting, inventory accounting across different industries. That's it. Quick revision. What is the objective of Ind AS 2? The objective is to prescribe accounting treatments for valuation of inventory. The scope: all inventories are included in the Ind AS 2, but except the financial instruments covered in 109 and biological assets and mineral ores. Definition: what do you mean by inventory? Inventories are held for in the course of business and in the process of production, and the materials and supplies consumed in the process of production of rendering of services. What do you mean by net realizable value? Net realizable value is estimated selling price less estimated cost of completion less estimated cost to sell, and then we will get a value of net realizable value. What do you mean by cost? Cost is a cost of purchase, cost of conversion, and other cost. What do you mean by cost of purchase? Cost of purchase include comprises of purchase price of the material or import duties paid and non-refundable direct indirect taxes and transportation cost, handling cost, other cost directly attributable to the acquisition of inventory. Next is cost of conversion. Cost of conversions are cost incurred directly to the production, such as labor cost, fixed and variable overheads. Next is other costs, which are necessary to bring the inventory to the present location and condition. Measurement of closing stock, that is finished goods or WIP, valued at lower of cost or NRV. If in case of raw material, we need to check whether the finished goods valued finished goods is sold above cost or below cost. In case the finished goods is sold above cost, we will value the raw material measured at the cost. In case the finished goods expected to sold at below cost, then we need to measure raw material at a lower of cost or replacement cost. So the Ind AS 2 describes there are two bases. Inventory can be measured two bases: item by item basis, group basis. There's an option of the entity it can measure. What is the cost of inventory? In case of purchase of goods, we'll add the value purchase price and the trade discount any should be deducted, and the rebate received should be deducted. Add import duty paid on purchase and the GST paid, which is non-refundable. In case of refundable taxes, it should not be included in the cost. Next, transportation cost, handling cost, insurance cost, buying commission. Then we'll get a value of purchase, cost of purchase. In case of goods are produced, the direct material incurred plus direct labor cost, production overhead, which has a variable or fixed overhead. The cost of production we will get. So the cost per unit is cost per unit is cost of purchase or cost of production divided by actual number of unit produced. How to find out actual unit purchased or produced? Actual unit purchased or produced will be calculated using units of closing stock of finished goods plus units sold, closing stock plus units sold minus opening stock of finished goods. Next, allocation of fixed overhead. How will you allocate fixed overhead? There is a absorbed overhead and unabsorbed overhead. Absorbed overhead means actual unit produced into fixed overhead recovery rate. How will you find out? Fixed overhead recovery rate? Total fixed overhead divided by higher of normal units or actual units produced. Higher of actual units or normal units produced. Okay. Then unabsorbed overhead, total fixed overhead minus absorbed fixed overhead will give you the unabsorbed fixed overhead. Example, in this we have seen this example. Refer. What are the costs are excluded from the cost of purchase and cost of production. The abnormal loss, storage cost, administration overhead, which is not necessary to bring the inventory to the present condition and location, selling cost, interest cost, as per Ind AS 23, not allows. It is not a substantial period to bill. Okay, wow. So finance cost, borrowing cost should not be included in the cost of inventory. Any cash discount or yearly settlement discount, it should not be included or deducted from the value of inventory. Cost of purchase are the cost formulas. There are two formulas. One is FIFO method, another one is weighted average cost method. In case of specific identification method, in that our items are not interchangeable and goods or services are produced in a segregated for a specific project. அந்த மாதிரி இருந்துச்சுன்னா specific identification method should be used. What do you mean by net realizable value? அது பார்த்துட்டோம். Lower of cost or NRV தான் வேல்யூ பண்ணுவோம். So write down பண்ணுவோம். If the cost is more and net realizable value is less, then we should write down the value of inventory to NRV. Recognition of expenses is recognized to profit and loss account. In case of sale of inventory, we will recognize the revenue. Okay. Joint cost allocation. How will you allocate joint cost? First, we need to identify joint product and byproduct. Next, compute NRV of the byproduct. Next, compute common cost. Common cost means what? Total joint cost minus byproduct, NRV of byproduct minus abnormal loss, not abnormal loss, the profit from sale of scrap minus பண்ணனும். Total cost minus NRV of byproduct minus scrap value, profit from scrap minus பண்ணா நமக்கு வந்து common cost கிடைச்சிரும். Common cost கிடைச்சதுக்கு அப்புறம் we'll allocate based on sale value at a split of point method. So sale value we need to find out. We'll get a value of sale value and allocate based on that value. That is 3 lakh or 2 lakh in our example. 3 lakh or 2 lakh. We'll allocate this uh, common cost. Common cost is 2,88,000. Be allocated among both the main product, that is joint products. We'll value the cost per unit and value of closing stock using cost per unit. That's it. What are the disclosure requirements? Accounting policies adopted and the carrying amount of inventory, that is raw material, work in progress, and finished goods. And the value of inventory carried at NRV. Amount is recognized during the year. Profit and loss account recognized money expenses. And the details of write down and reversal of during the period. That's it. Ind AS 2 is done and dusted.